Futures are down. Volatility's up 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment. Bloomberg Open Interest, though, it starts right now.
Coming up, markets are on edge. Investors await Friday's jobs report for clues on the Fed's cuts as tensions remain high in the Middle East. Levi slumps as the denim maker lowers its revenue growth outlook for the full year. And the CEO, Michelle Goss, joins us in the next hour for a C-suite conversation. The stock has gotten decimated. Plus, a warning sign. Credit investor Victor Koshla tells Bloomberg there's a tsunami coming through in U.S. office real estate. Let's take a look at where markets are trading right now. In terms of futures, as I said, we're looking at losses on the S&P. Not huge drops here, just a third of 1%, almost half of 1% on NASDAQ 100 futures. And you can see the 10-year yield climbing about 4 basis points right now at 382. So markets are on edge. As I said, volatility is much higher right now. Katie's got to look at some of the stocks.
You're seeing that volatility under the surface as well. If you take a look at the single stock level, as Matt mentioned, Levi Strauss falling in a big way. That's after it missed sales estimates. It lowered its full year revenue outlook to the bottom end of its previous range. Shares currently down about 11% pre-market. Let's also take a look at Stellantis here. It was downgraded by Barclays amid profit concerns in the auto sector. That's worth a 4% decline. And then we do have a little bit of good news. We're watching shares of Constellation Energy. Remember, it struck that deal with Microsoft to power its data centers with nuclear energy. Now there are reports that Google is reportedly considering nuclear power for its data centers as well. That is lifting the whole sector, including Constellation, Matt, currently up almost 3% pre-market.
All right, let's take a look at that volatility that we've been talking about, because it's not atypical for the VIX index to rise in October, usually because of elections coming up. Options pros tell us, though, right now, that's not the case. It's really about the direction of the U.S. economy and, I guess, the size, we know the path, really, of Fed rate cuts. I heard Amy Wu Silverman on Bloomberg Radio this morning saying that even though traders think that the market is going up in terms of just the stock index itself, they're still buying a lot more downside protection than they typically do, and that's why we see volatility higher.
Yeah, it is really interesting. And of course, the textbooks would tell you that volatility up, stocks up. It can't happen. You can't have it both ways. So it'll be interesting to see how that shakes out. We are at a really interesting juncture in markets, though, right now, because, of course, we have the U.S. economy doing well. We have China stimulating their economy. But at the same time, we have all of these geopolitical conflicts that we're worried about. And, of course, we also have that port strike still going and expected to last. So a lot of cross currents here, and you're really seeing that in the month of October. It has not been too pretty.
Yeah, no, and don't forget the hurricane, right? So we've got the problems in the Middle East, you got the port strike, you got the hurricane, the election coming up, and then the Fed. Let's bring in Jack Janasiewicz, Natixis portfolio manager and lead portfolio strategist, to talk us through some of these things. Of those headwinds, Jack, can we put the Fed really away? I mean, we know the Fed is cutting, right? Maybe they're not going to do 50 basis points again in November, but they're still likely to go 25.
Yeah, and again, thanks for having me on, Matt. And you know, the key there is simply that the Fed is easing. And I would actually widen back out that scope and say, you've also got the ECB easing. You've had very dovish commentary from the Bank of England. You had some dovish commentary, you know, coming from the BOJ. You know, all in all, global central banks are all leaning towards one way, and that is dovish easing. Throw in that fiscal stimulus that potentially could be coming in size from China. Those are some pretty good tailwinds. And so the geopolitical stuff tends to fade away over time in the near term. And those tailwinds that we just sort of highlighted with central banks' liquidity support, I think, is going to be the big driver going forward here.
So what you're saying is, I mean, typically we have some election volatility, especially ahead of a presidential election year. And now we have geopolitical adding to the dips. You want to be a buyer of those dips?
You know, absolutely. And I would even argue maybe the best thing for the markets in here would be November 6th, right? We're finally past that election point, and even point to some of the things that we're reading in the ISM or in the Beige Book comments everybody's basically saying delayed but not destroyed, right? They want to get past the election backdrop, and then they expect to sort of resume normal business operations, so to speak. So delayed, not destroyed, pent-up demand. Let's get to the November 6th here, and I think you're going to see the market start to get a little bit of its traction and head higher.
Well, Jack, of course, there's no guarantees that we'll know who actually won the election on November 6th, but that's a conversation for later down the road. Let's talk about that buy the dip impulse, of course, that you have here. Is that just a blanket buy? Or are there specific sectors, specific spaces that you would look for that opportunity right now?
No, we're still focusing on the U.S. markets and really still staying up in cap. But I think from a sector perspective, we think the cyclical value barbell with tech still works in here. So we think tech, even though you potentially could get a little bit of broadening out in that breadth, which may put a little bit of pressure on some of the mega cap names, I still think some of those names will work. And then at the cyclical value side, think of things like industrials, financials, and to a lesser extent, even materials. We think those probably start to pick up some steam here as we head into the end of the year.
Okay, so if we visualize that barbell, of course, you've got tech over here, then you have cyclical and value names over here. Who's left out in the cold here? What does that leave out?
That's still going to be your classic defensive plays in here. And again, we're still optimistic. We still think this is more of a soft patch. You've got that support from the Fed and global central banks. We just don't see a real need to be leaning into defensives right now. So still staying in that growth complex, in the cyclical complex, and that leaves the defensive sort of left behind in here.
I got to ask your take on labor. In your notes, you lay out a big argument for what you understand the Fed is doing right now. Labor obviously is hugely important to them, more so than inflation. Are there really downside risks? Every time I talk to a small or medium-sized business owner, they say getting good labor is their biggest problem right now. They can't find workers that have the skills. The costs are too high, even with low skills. And there's a weak commitment. They can't get workers that are going to stay. Do we really have concern that they're going to, we saw the JOLTS job openings number jump up to 8 million again. Are there really concerns about labor?
I think the focus really should be on the layoff side of the equation. When you look at things like the prime age workforce, we're at cycle highs when you look at it in terms of labor force participation or the employment to population ratio. So that tells us that cohort of 25 to 54-year-olds, it's really never been higher over the last 30 years or so. So as we get closer to full employment, it becomes a little bit more challenging to add jobs. And so I think the more important thing to look at here is the layoff side of the equation. And we're just not seeing signs of that. And the big takeaway for us here is simply corporates need reasons to start laying off people. You've got margins expanding. You've got earnings estimates pushing higher. You've got maybe a soft patch that ends up dismissing itself and working back into a more normal level. Those, to me, aren't reasons why corporates should continue or start laying off employees in here. So maybe we're at the stasis where we don't have hirings, but more importantly, we don't have firings.
Yeah, and perhaps we saw evidence of that in the initial claims data that we got this morning, of course. Not exactly evidence of huge layoffs underway, but of course, we're all counting down to the jobs report that we get at 8:30 a.m. tomorrow morning. I'm taking a look at your notes, Jack, and you write about this asymmetry that has emerged with respect to incoming data, especially when it comes to the labor market. Walk us through that asymmetry and, of course, what you're expecting to see in the markets in reaction to what we're going to get tomorrow morning.
I think good numbers will be considered good and bad will be bad. So when we think about the labor employment report coming up tomorrow, if we get a number that's close to 140, 150, maybe even on the upper side 160, I think that's taken as a good sign because it gives a little bit more, I think, backing to the labor market, not really decelerating as fast as maybe some have been implying. If we get a significant miss or at least a weaker miss, that probably gives the Fed more room to actually continue to cut rates. So as the economic numbers decelerate quicker in here, I would expect to see the Fed starting to move up and potentially going a bunch of 50s in here. So the Powell put, that's, I think, the key takeaway. As the economic data potentially weakens, the Fed probably steps up its rate cutting cycle here. And I think that puts a floor underneath risk assets because of that.
And Jack, before we let you go, of course, this conversation focused on the U.S. That's where you want to be from a market perspective right now. Let's talk about China, though, of course, and that big measures of stimulus that we got. Maybe not a bazooka, but certainly, of course, a blitz of stimulus measures, not really making an impact in either way when it comes to U.S. markets. How are you factoring that in, of course, to this overall bullish view that you have?
You know, the China story really comes down to, confidence in the economy, and, the transition or the linkages between the equity market and that confidence aren't quite as strong, I think, in China as it would be, for example, in the U.S. through that wealth effect channel. But, we've seen in the past rates have come down, credit's been there, so it's not an issue of the price of credit or the availability of credit in China. It's more that confidence to actually want to borrow and actually do something with that. So, addressing a lot of these concerns through the confidence channel, through credit, I'm not sure that gets to the heart of the problem here. I think the issue for us is you need confidence, which really comes on the fiscal side. So, yeah, the measures near term help the stock market. We're still waiting to see that big bazooka really come through on the fiscal side. And if we get the fiscal side, that, I think, changes the game here.
All right, Jack, always great to speak with you. Appreciate your time. That is Jack Janasiewicz. He is a portfolio manager and lead portfolio strategist over at Natixis. Meanwhile, we take a look at the futures right now. About 20 minutes to go until the bells ring. You can see we're shaping up for a down day in markets. The S&P 500 currently down about 0.3%. Something amazing happened yesterday, Matt. I know that you were off, but the S&P 500 was almost exactly unchanged at the close. Don't often see that.
I saw that, like 0.1% down at the close. I was off, but still paying attention.
Right, of course.
I was recording my podcast, which is called Bloomberg Hot Pursuit with Hannah Elliott. You can access that on Apple Podcasts or wherever you get your podcasts.
He wasn't on Open Interest, but he was working on another show. Meanwhile, let's get a look at stocks moving underneath the market. We're going to do that with Jess Menton right now. Talk to me about NVIDIA, of course. Jensen Huang saying some pretty bullish things.
And it's important to watch this stock, obviously, because of the weighting it has in the S&P 500. And so when you see this at a stock like this, it actually invested in OpenAI. And this came on the back after OpenAI said it had an investment round in the latest earlier this week around over $6 billion. And so that's important because this will give NVIDIA insight into basically how the chip processing is working for OpenAI. And then also when you think about the graphics processing that works when chips like this, that obviously gives that some insight into what they're doing. But also this came on the back after NVIDIA's CEO just said that the Blackwell chip demand is insane. And there were concerns, obviously, as we knew in recent weeks, about what that could mean for the demand moving forward. So you have this in the stock and pre-market trading, NVDA is the ticker symbol, up over 2%. If you look at other kind of chip makers in the space, AMD's actually up just slightly right now, around 0.1%. And then also Broadcom, though, down about 0.5%. So today it'll be important to watch what the SOX is doing because actually last quarter it was down over 5%. So it snapped about 3 consecutive quarters of gains there. But Evercore ISI actually made a call that they really felt like because of those declines in the third quarter, they felt like chip makers could rebound in the final 3 months of the year. So it'll be important to see how this kind of shakes up in the coming weeks.
It's kind of amusing that NVIDIA is moving on this pre-market because what else would Jensen Huang say?
Yeah.
Of course he would say there's crazy demand.
He's talking his book, but it's only a 2%, which is
for NVIDIA.
I guess that's still a lot for a $3 trillion stock. I'm looking at HIMS. By the way, speaking of podcasts, I first discovered this company on Dax Shepard's podcast.
Oh, really?
Yeah, because
he's got a great podcast.
It's fantastic.
It really
it's my second favorite after my own, which is called Hot Pursuit.
What about my podcast?
I like the plug there.
I like it too, but
boy.
So they used to make products just for guys. It was like about hair loss. I'm not sure if that really works. Erectile dysfunction stuff, but now they have hers also because they got into weight loss, right? They get into the GLP-1s. And while you couldn't get enough from Eli Lilly, maybe you were looking at options like HIMS and hers.
Right.
But now Eli Lilly apparently has enough drugs.
And that was the big thing because the FDA back at the end of 2022 talked about how there was this drug shortage. And so there were companies like him and hers that benefited at this. But if you look at HIMS as a ticker symbol, down about 12% ahead of the opening bell. So really this came after this weight loss drug shortage is ending for Eli Lilly. But if you look at BMO, they're making a call for Eli Lilly as far as what this could mean for their manufacturing. If you look at his stock, up about 0.2% ahead of the opening bell. But also that stock for Eli Lilly is up more than 50% year to date. So they feel like because this shortage is ending, that could really help their manufacturing capabilities. So that's really helping supporting the stock right now.
I do think if any company ever came out with a cure for male pattern baldness,
oh my God,
that's like the holy grail, right?
The white whale, if you will. Yeah, that would be huge. Okay. Jess Menton, we have to leave it there. It is always a delight to see you at the desk. That, of course, is Bloomberg's Jess Menton.
All right, coming up, President Biden warns Israel against striking Iran's nuclear facilities. They'd have to use bombs made here to do it. We'll bring you the latest next. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. LVMH and Formula One have signed a major 10-year sponsorship deal, potentially worth around $1 billion in total. The French luxury group has usurped Rolex's spot as one of the race's top sponsors. LVMH is upping its presence in the sporting world after being a major sponsor for the Olympic and Paralympic Games in Paris this summer. You could soon see Tag Heuer signs all over your F1 racing screen. Tesla is issuing its 5th recall in less than a year for its polarizing Cybertruck. The problem involves a delay in the truck's backup camera when drivers shift into reverse. Tesla deployed a software remedy last month to fix the issue. The company said the software issue affected only a small portion of an estimated 27,000 vehicles. And overnight in the Middle East, Israeli warplanes dropped bombs on Beirut after 8 IDF soldiers were killed in fighting around southern Lebanon. Israel claims to have killed 15 Hezbollah fighters in the strikes. While the conflict rages on, the U.S. has been urging Israel not to attack Iran's nuclear facilities in retaliation for Tehran's missile barrage. Katie?
The latest on the American response is Kayleigh Lyons. She is co-anchor of Balance of Power, joining us from Washington. Talk to us a little bit more about President Biden's response. Of course, when asked whether the U.S. would support such an attack by Israel, he said that the answer is no.
Yeah, look, Katie, the president has been very clear that the U.S. is going to continue to support Israel's defense, which includes things like helping shoot down missiles that were sent Israel's way earlier this week. The U.S. Navy was involved in those operations. Offense, though, is a whole different ballgame, and there is reluctance on the part of the administration not only to get U.S. troops more directly involved, but also to risk escalation. And that's what we have to consider when it comes to these nuclear facilities, because they are not easy targets. Iran has these facilities buried deep underground, so it would be very hard for Israel to actually reach them in a strike without the support of the United States. And I was speaking about this with Congressman Seth Moulton, who is a Marine combat veteran. He served multiple tours in Iraq, is very familiar with the Middle East. And he said the issue here is what Iran would do in response. If it has its facilities targeted, that could lead Iran to actually develop more quickly a nuclear weapon versus just the materials that go into a nuclear weapon. It's just unknown what kind of retaliation Iran could want to pursue in that scenario. In the meantime, of course, Israel, while it's still calibrating what exactly it wants to do to hit back against Iran, is continuing its operations in Lebanon. The IDF just put out a statement saying that Army fighter jets have struck targets belonging to Hezbollah's intelligence unit in Beirut as we continue to see the death toll climbing there.
I have so many questions around this nuclear issue, Kayleigh. I mean, I understand that Iran is still a year away from being able to make a nuclear weapon, or that it would take them that long to do so, and that the U.S. 2,000-pound bunker buster bombs would be needed in order to reach those underground nuclear facilities. But doesn't Israel already have those in its arsenal? And wouldn't the whole world breathe a sigh of relief if those nuclear facilities were destroyed, thus taking away Iran's ability to build a nuclear weapon?
But that's exactly what Congressman Moulton was trying to say, Matt, is that while it does seem like a simple solution, just take out their capabilities, there is no guarantee that their capabilities will be taken out entirely, and their response could actually be to double down and try to ramp up weapons production more quickly, considering they've just been developing the materials to this point. Now, when we consider Israel's ability to do this, yes, the U.S. is providing Israel with a number of things, has withheld some heavy bombs for use in Gaza over concern of civilian casualties there. But this is the real question of leverage that the United States has or does not have to exercise over Israel and its decision-making here. Because, yes, the U.S. is providing Israel with the means to defend itself, providing defense. If they were to take that away, it threatens Israel's existence if the U.S. looks like it's turning away from this ally that is facing threats not just from Iran, but from its proxies. On the other hand, that means it's very hard for this administration to actually influence the decision-making of the Netanyahu government. We've seen that borne out over the last several months as they've been pushing for a ceasefire, not just with Hamas, but more recently with Hezbollah, and Israel has kept on, keeping on, if you will, as they pursue their objectives here.
And Kaylee, we only have about a minute left with you, but we should talk about what's going on stateside in the U.S. Of course, I'm talking about the port strike ongoing. President Joe Biden saying that it would be a man-made disaster to have a prolonged port strike. But he's walking a difficult line here, of course. I mean, the unions have said that they don't want him to interfere.
Well, yeah, and he is going to continue to support the unions. He is placing the blame here strictly on that of the port employers and the shipping companies, noting the profits they were able to rake in during the pandemic, saying that the union workers need a fair share of those profits. And he's telling these companies to bring a better offer to the table, essentially, in order to get these negotiations underway, because right now they are at the standstill. The union is maintaining, unless their wage demands are met, which is a 77% increase over a 6-year contract. They don't even want to begin negotiations on other issues, including automation, which may be more difficult to sort out. In the meantime, not just Biden, but Kamala Harris has to deal with the potential economic ramifications of it as we get closer to the election, while also not wanting to alienate the labor vote. And that is especially in focus for Harris today as she campaigns in Wisconsin and Michigan, blue-collar strongholds.
All right, Kaylee Lyons joining us from Washington with the latest. Appreciate your reporting, as always. Now coming up, climate proofing your cup of joe. Starbucks has a plan for that. Details in our Social Climber segment up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, NVIDIA expanding its partnership with tech consultant Accenture in efforts to boost corporate AI adoption. Accenture has trained 30,000 experts on the use of NVIDIA's technology to help their customers use AI. Next up, Starbucks trying to make coffee more resilient to climate change. The company is buying 2 research farms in Costa Rica and Guatemala that will test everything from drones to microbes in efforts to combat drought and diseases. And finally, the Maui Fire Department is releasing the results of its official investigation into the cause of last year's fire. The conclusion is that the Maui fire was caused when Hawaiian Electric re-energized broken utility lines. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, we take a look at futures right now. Just a couple minutes until these bells ring, and boy, there is red on this screen. The S&P 500 down about 0.3%, a little bit more if you take a look at the Nasdaq 100, off by about 0.5% right now. Not seeing any relief, any follow through to maybe some of the positive vibes that emerged yesterday. The Russell 2000, even worse, currently off by about 0.6%. Coming up, less than 4 minutes until the opening bell, we'll discuss the market moves with Aoifinn Devitt. This is Bloomberg.
All right, we are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We do see futures pointing lower. Not huge drops, just 0.25% for the S&P 500, about 0.5% for the Nasdaq. Yesterday was virtually unchanged, but the arrow was still red. So after the almost 1% drop that we got on Tuesday, if we are down today, it would be 3 days in a row. Here, the New York Stock Exchange bell ringing right now. Front view ringing the bell down there at the NASDAQ market site. You've got AIMT, I don't know.
Italian-American?
Italian-American.
Yeah.
Okay, they mixed up the letters there, so I couldn't really pull them apart visually. I have a dyslexia issue. I'm not sure if that affects it. In any case, we got the opening bells on both the New York Stock Exchange and NASDAQ marketplace. Katie Greifeld, what do the indexes look like?
Well, I put the same indexes on the board every time, so not a lot of reading involved for me. Just numbers, and the numbers are going down. The S&P 500 currently off about 0.2%. The NASDAQ 100 a little bit more, 0.4%, and then a little bit more even if you take a look at the small caps. The Russell 2000 currently off by about 0.6%. Of course, an interesting juncture in markets right now. We had a really good September. October, can't say the same yet. Meanwhile, you take a look under the hood. Some stocks to watch right now. We have Levi, Strauss falling in a big way after sales in the third quarter came in below estimates. That, along with the company lowering its full-year revenue outlook, has shares down almost 11% right now. We'll discuss all of it with the CEO in our next hour. Meanwhile, let's take a look at Stellantis. It was downgraded by Barclays in a review of European car makers. The analyst also downgraded Mercedes and Porsche as profit warnings in the sector spook Wall Street, spooking shares of Stellantis right now, currently off by about 4.7%, Matt.
All right, we're also watching shares. By the way, I am interested in those car stocks. I did hear that, and man, have they had a tough time lately. But I want to switch to nuclear. We're watching shares of Constellation Energy. It struck a deal with Microsoft to power its data centers through nuclear energy at 3 Mile Island. Now Google is reportedly considering nuclear power as well for its data centers. Let's discuss nuclear's potential resurgence with Bloomberg Intelligence senior analyst Anurag Rana, who not only covers the tech stocks for us, but also was a physics major. So Anurag, you know what you're talking about here. It's not surprising, is it, that Google would look to this power source, which has the potential to generate clean energy to power its data centers?
Absolutely right. So when you look at all these big tech companies, the one big pledge that they have done or taken is that they're going to be carbon neutral sometime down in the future. Now, if you're running AI workloads, if you are seeing more AI workloads coming into your data centers, I mean, what option do you have? You're not going to go out and go for a coal power plant. You're really going to need some kind of renewable energy. And, I think nuclear is one choice over there. But the only problem is you just can't whip up a nuclear reactor overnight. It's going to take a lot of time for that to really come to fruition.
Well, let's talk about that a little bit more. We were having this discussion in the commercial break. Just how long does it take to spin up nuclear? Because, as you said to me, it's not like you can exactly flip a light switch here.
Yeah, I mean, I'm, again, not an expert in nuclear reactors from that sense, but I would say at least a decade. But if it's a smaller one, maybe a little bit, lower than that. But it's not something that can be done over the next 3 to 5 years is the way I look at it. Now, at the same time, there are newer technologies in play, but we haven't seen any new construction of any of these in the last several years. So everybody's expecting some kind of a newer way to do this. But again, this is very uncertain at this point.
I mean, it's all about getting the energy, it seems, Anurag. Whether you're a Microsoft, a Google, an Amazon. I was just scrolling through Google's ticker. Apparently, they're tapping the Adani Group in India to get energy for their cloud services there. And then I, went in a deep dive. All these companies are looking to power their cloud any way they can. Is that, you think, a big play? Could nuclear or power generation be kind of the AI of the new AI play of this year?
I mean, in my view, it's not the new AI play. I think a lot of those stocks have seen a fair amount of jump in the last 12 months or so. One thing is for clear, we have seen a massive amount of interest by companies in AI. We just published a note that all the top tech companies over a 2-year period have increased their capex by about 65 billion. In 2025, they will spend somewhere close to 200 billion in capital expenditures. That's a lot of money going from a little over 100 billion 2-3 years ago. So where is all that money going in? It's going to expand their data center, buying chips, buying hardware, spending money on large language models, investing in places like OpenAI. So this is not something, in my view, that's a fad at this point. Everybody's investing in it. And power seems to be the biggest bottleneck at this point. And I think they are preemptive in terms of investing now so that they don't have that big shortage 3 to 5 years from now or longer.
All right, so it's not a fad, but specific to nuclear, it might take, about a decade to really scale up here. Anurag Rana from Bloomberg Intelligence, really appreciate your time. Meanwhile, let's broaden out this conversation now with Moneta Chief Global Market Strategist Aoifinn Devitt joining us now. And Aoifinn, you think about the U.S. market. On the good side, you have a strong economy. The Fed is cutting rates. You also have China stimulating their economy. Good signs there for the global sort of marketplace right now. On maybe the bad side, you have hot wars. You have supply chain angst. You also have election volatility. When you weigh all of those factors together, where are the scales tipping for you right now?
Interesting. We're starting to see a very different shift in how markets behave. Previously, the negative factors that you mentioned, the geopolitical volatility, the election uncertainty, and many of the factors just around the trading partners, that would have had a much heavier bearing on market activity and sentiment than it is today. And that's something that we're still trying to figure out why. Why are markets so resilient when these factors remain quite volatile and quite unpredictable? So in light of that, it is not wise to bet against markets. And certainly where that has been the case and investors have tried to exit markets at moments of volatility, that has shown time and time again not to be a winning strategy. So we are encouraging our clients to stay invested, stay the course, stay broadly exposed, which means not having everything on one theme or in some of the high octane stocks or themes, and also to now be thinking quite sensibly about what to do with their cash. It was fine to sit in cash for some time. That clearly is going to start ticking down. So we're looking at some of the other, whether it be other fixed income solutions or bond substitutes, et cetera, that can be a slightly better way to diversify the portfolio.
Well, that's interesting, Aoifinn, because you think about cash on the sidelines, that narrative that's out there, and a lot of people point to that as bullish for equities, thinking that, you know, that money that's in money market funds will eventually cycle back into the equity market. But it sounds like that's not the case for you, that you would put it right back into fixed income.
First of all, there has been a lot piling into money market funds. We've heard the 6 trillion number. We've also seen about 20 billion come out of money market funds in recent weeks. So that's a suggestion that investors are already not so enamored with what these money market funds can deliver. I would say not necessarily to put it into fixed income, because fixed income, the spreads are quite tight. We've seen that on investment grade as well as high yield. Perhaps they were tight because the absolute return, when you factor in the risk-free rate, was still quite attractive. So there was strong demand for these fixed income instruments. But now that that base rate is going to be coming down, they don't look quite as attractive any longer in light of the risk that's inherent in them. Remember, we haven't had those credit events. Nothing has been tested. So perhaps things are artificially robust. So what I'd say now is where we would go is not necessarily right back into equities, although we're maintaining our equities. It's starting to diversify back into those bond substitutes that have received very little love recently. And that's things like real estate, real assets, infrastructure, things that do pay a dividend-like income stream and should be quite resilient to inflation. Inflation hasn't gone away. It's not at double digits any longer, but it's still there. And we still need to make sure that portfolios protect their purchasing power.
I want to shift to the China issue, Aoifinn. Katie mentioned it on the positive side of the ledger, and we did see the CSI 300 rise, I can't remember, 8 or 9 days in a row.
I think it was 9.
It was 9, no, 9 days, exactly. It was 9 times that we saw it. In any case, so much optimism and momentum in Chinese stocks that hasn't really bled into the U.S. market. And I think one of the concerns is that they just aren't pulling out all the stops, right? The Chinese aren't doing as much as they possibly can. Now, apparently, there was an interview with the former head of a research institute affiliated with the Ministry of Finance in China, Jia Kang. He spoke with a Chinese publication called The Paper and said he could see Beijing putting as much as 10 trillion yuan into public spending, which is like $1.5 trillion. If they come out with such big stimulus, really following up what we saw last week with more, exponentially more, do you think that then has really positive effects on U.S. stocks as well?
I don't see it having much effect at all on U.S. stocks, actually. It's quite insulated from there. Most of our investors are quite, I'd say, cautious around China. They're cautious around emerging markets. They don't necessarily want Chinese exposure. They're watching from the sidelines. I don't think anyone will bet against China and its ability to stimulate the economy. Even when you look at staggering numbers, like the number of ships being built in China versus in the US, it's a ratio of something like 243 to 1. The Chinese economic story is explosive and always has been. We know from EV numbers a similar thing. The issue is, do US investors want a piece of that action? And so far, we really haven't seen that. What will be interesting, though, is perhaps a negative for China is the outcome of the election. And we know that certainly the rhetoric on both sides is not particularly friendly. But on one side, it's a lot less friendly overall to any form of more of a trading relationship. So I'd say that is something that's a negative for China. So not many investors on these shores are picking over the spoils of China's markets right now.
Aoifinn, how do you expect the U.S. elections to play out in U.S. markets?
Well, I'm not sure that's really my pay grade, but certainly for U.S. markets, I mentioned before the resilience of markets. They, I don't think, will be as resilient as we would have expected going into this. in that we can see that there's a lot more volatility now, given the uncertainty. Your own columnist, John Author, is speaking about the potential for an October surprise. There always is some form of a surprise. And with the geopolitical rumblings that are quite severe in the background, there's a lot of uncertainty now baked in to this month of October coming. And as I've mentioned before, this election is very much binary in terms of what's likely to happen around the impact on trade, trading partners, and tariffs equals inflation and GDP compression across the world. So that is going to have negative impacts.
Aoifinn, thanks so much for joining us. Moneta's Chief Global Market Strategist, Aoifinn Devitt, talking to us about markets and in relation really to geopolitical risk and benefits.
Yeah.
Coming up, Front View and Standard Aero both went public yesterday as JP Morgan says the market for IPOs is very open. We'll talk to Bailey Lipschultz about this next. This is Bloomberg. Let's turn to the IPO market now. Shares of Front View, a REIT, continue to fall on their second day of trading. The company focuses on businesses in high-traffic locations. But earlier today on Bloomberg Television, we heard from SVP's Victor Koshla about his outlook for the property market, specifically office.
In office in the U.S., there's almost a tsunami coming through. You don't see it in the headlines quite as much, but underneath those debt maturities we were talking about, they are causing a tsunami.
Bloomberg's Bailey Lipschultz covers IPOs and joins us now. We have a couple to talk about, but I wanted to focus on this REIT first because of Koshla's comments. It has office in it. Aren't there concerns about commercial property?
Yes and no, Matt. I think when you look at the portfolio of the company, it was a smaller IPO, only about $250 million raised. When I talked to REIT investors in particular, they were meeting with the company, but they did kind of call out it's a smaller float in terms of the shares listed. It's not a big company, so the allocation was not necessarily kind of groundbreaking, but it is interesting nonetheless to see a company that does have a form of office or your traditional retail-facing REIT going public again when we saw Lineage, the biggest IPO of the year, going a few months ago.
So that was interesting, of course, to see a REIT come to market. Let's talk about Standard Aero. This was interesting for a couple reasons. First of all, they raised $1.4 billion in their IPO. At first, I was like, that isn't that much money. But then I saw your size and scope in your story.
Still a lot of money. Yeah.
It's, I mean, I wouldn't say no, but it's the best performance for a U.S. IPO, raising more than $1 billion since Toast all the way back in 2021. Yeah. This was very well received.
Well received, and the thing we were keeping an eye on, Katie, was would it outperform ARM, which had so much fanfare going public last September, and clearly it did. This is one of the big IPOs that we saw investors really circling. This is Carlyle back. They were exploring a dual track. Would they sell the company? Would they take it public via IPO? When I talked to the CEO yesterday, he really applauded Carlyle going the IPO route, and I know a number of investors who bought the stock who said, we don't want this to get bought by another private equity firm. We want this company to go public because we love the business. We love the comparisons against a GE Aerospace. We saw Loar go public earlier this year. The aerospace area has been phenomenal.
Well, it's also interesting that they decided against a sale, that they would rather go the IPO route. I feel like maybe that's a little bit of a sign of the times.
I think the big question comes back to valuation and valuation expectations. Could you get a few more turns going public via IPO than being an outright sale? Yes, but what do you value? The cash in pocket that you can return to LPs. We've seen such a kind of backlog of exits for private equity, but it does seem like that really is opening up. And that's something we're watching, especially this month in October.
I noticed one of the investors in OpenAI in our story yesterday was like, this is great news for the IPO. Like, he's already there, you know?
I mean, it's a huge company. We're already talking.
That would get me excited. $157 billion?
Right. But, I mean, NVIDIA's worth $3 trillion. Surely OpenAI can get a much higher valuation when they have all of the public clamoring for their shares, right?
Yeah, I mean, that's a name that retail is going to love. I think the big question when I talk to late-stage private investors who shied away from OpenAI is when they want to see a 3x in 3 years or 5x in 5 to 10 years, the question is how big can OpenAI get and how quickly? And obviously we've seen so much turnover within management that there still are questions there, but nonetheless a phenomenal business and a huge valuation.
So looking forward here, not exactly to OpenAI, but of course, coming back to Standard Aero, Carlyle backed. You had a really interesting interview with the JP Morgan Chase banker who was basically saying that when you think about the window for PE-backed IPOs, it's wide open here. It's
wide open, that's what he said, and that's something, again, that we're going to be watching. Partners Group is bringing KinderCare public next week. CVC has a stake in Move Lubricants, who's expected to price next week. Ingram Micro has been a name that we've been tracking, platinum backed. So we're seeing a number of companies going public. And as Keith Canton from JP Morgan had said, next 10 to 15 days will be critical for those PE backed companies. And that really could set the tone for 2025 when we expect a more open IPO market. But again, we've been talking about the IPO market being a few months away from opening up for about 3 years at this point.
Well, I'm sure plenty of those PE firms were really happy to read that interview, of course, looking for an exit here. Bloomberg's Bailey Lipschultz, always a great time seeing you. Now, coming up, the Miami Dolphins are nearing the NFL's first private equity deal. We'll discuss next in today's Wall Street Beat. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's take a look at how stocks are faring about 22 minutes into the session. Not too well. The S&P 500 currently off about 0.3%. You take a look at the NASDAQ 100 trying to go green here. We are back to just about unchanged on the big tech index. Can't say the same for the small caps. Of course, the Russell 2000 deepening its losses right now, currently down about 0.9%. We'll continue to keep an eye on that one, but it's time now for the Wall Street Beat. We are nearing the NFL's first private equity deal because Bloomberg was first to report that Miami Dolphins owner Stephen Ross is said to be in advanced talk with private equity firm Ares Management and Alibaba Group chairman Joe Tsai to sell stakes in the team. Now, sources say that the deals include other assets and could be valued at $8.1 billion. Let's discuss with Bloomberg's Randall Williams, who broke the story. And this was pretty fast. I feel like we just had the vote.
Yeah, the vote happened in August, and now we have a deal in October. It's like less than 40 days later. It's pretty quick.
So in terms of the valuation, it seems to me huge. I'm an older man. Is this how much NFL teams are worth now? $8 billion?
Well, the average, according to Sportico, is around $5 billion. This is massive. And it also includes, the outside of the Dolphins, it's Hard Rock Stadium, it's the Grand Prix, it's the Miami Open, which is a tennis tournament. So there are some other things that are helping it get to that 8 number, but it is a huge, huge number.
So it's a huge number that has to draw a lot of eyeballs. And like you said, we're about 40 days since the vote here. Have to imagine that more are coming. Oh, for sure. For sure. The NFL is encouraging teams to get these deals done quick, in large part because it raises valuations. Some of these owners have succession issues, it's dealing with the state taxes. Some of them have stadium things, and some of them just want liquidity. Ross could be all of these. He's not short on cash. Maybe he wants to invest more in the Miami district, all of those properties that he owns. This money can be put towards helping that, developing the real estate around it, or just wanting more cash. Yeah, or maybe diversify a little bit. When I saw the headline, it was the Ares name that got me. Seeing that and the Dolphins in the same headline made me click. What are the other PE companies or groups that we could imagine coming in, or do you have any said they are interested? So there are 3 other groups that are approved. There's Arctos Partners and there's Sixth Street Partners, and then there's a consortium that is comprised of a company named Ludus, Dynasty Equity, Blackstone, Carlyle, and CVC. So it's a lot of money, and there's a lot of conversations going on between these groups and NFL teams. It's just a matter of time as far as when these deals get approved and when they're taken to the NFL for a vote. And we don't have much time left, but talk to us about sort of the history of these specific assets, this specific deal, of course, with the Miami Dolphins. At one point, Ken Griffin was interested? Yes, those talks fell apart earlier this year, but Ross continued to have conversations with a lot of different people, and eventually he landed on Ares. I think that there will be more deals. The Buffalo Bills are having a stadium, or excuse me, they have a 25% stake on the market right now. We've been told that the Eagles are exploring a similar stake sale. So it's only a matter of time. These things are going to happen pretty quickly. These owners want cash. You love the Bills and the Eagles. You love cold weather teams, Katie. I do. I'm just saying, we have an internal chat, right? And Katie's like, I love the Bills. I love the Eagles. I do. I'd rather be in Miami. I would rather be in Miami. I've tailgated at 2 Bills games, but both in New Jersey. I haven't actually been up in Buffalo. Did you break a table? Yes.
Nice.
Anyway, moving on.
Yeah, Randall, thanks so much for joining us. Hope to see you more on this show. Randall Williams covers sports for us at Bloomberg. Coming up in the next hour, we're going to talk to the CEO, Levi Strauss, Michelle Goss. She's going to talk about the retailer's drop in revenue guidance and the state of the consumer. But really, it's about the outlook that we're going to be asking her, because the shares, at least in the pre-market, I saw this morning, down 12%.
Oh, yeah, having a horrible day so far. Currently down about 8.5%. That was 11%, but that was only its worst drop since about June or so, only a couple of months. So a lot to discuss, of course, with the CEO of Levi Strauss. This is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Meanwhile, let's take a check on these markets. We are awaiting some data, of course, at the top of the 10 o'clock hour, but you take a look at how markets are faring right now. Much of the same. Of course, the S&P 500 still down, but the big tech index managing to go green, Matt, currently up about 0.2%.
All right, we got ISM Services Index, a reading of 54.9. We were only looking for 51.7. So that's a beat. The prices paid higher than had been anticipated at 59.4. We were looking for services prices paid at 56 even. We got the employment number a little bit lower at 48.1. We were looking for 50 even, so under 50 for the ISM services employment number. And then new orders much higher, 59.4. We were looking for 52.5. In order to make sense of all of that data, we bring in our economics and politics expert, Michael McKee, standing by. Mike, what do you see in this ISM data?
Well, this appears to be the highest ISM services number since May of 2022. So it does suggest some strength in the economy that maybe wasn't anticipated. As you mentioned, though, the employment number goes down below 50, 48.1 from 50.2. And that suggests that maybe we will see a little bit more weakness in hiring. Now, the ADP number for services came out yesterday at 104,000, so that was pretty low. We'll see if people incorporate this into their overall estimates for what's going to happen. New orders were up, though, 59.4, and business activity 59.9 from 53.3. So it does look like some good news on the services side, just not hiring at this point, and it may be part of the whole thing that we're seeing with the labor market, where people are waiting to see what happens with the election, what happens with the strikes, and what happens post-hurricane to decide whether they're going to add more people or not.
Certainly a lot of uncertainty ahead. Michael McKee, we thank you so very much for breaking down that data with us.
I like the way you put that.
Oh, thank you.
Certainly a lot of uncertainty.
I didn't even do that on purpose.
Yeah.
But also interesting here, we're going to talk more about that economy tomorrow at 10 a.m. Do not miss it. With certainty, we were going to be joined here by Chicago Fed President Austin Goolsbee, speaking to Michael McKee. And of course, this drift higher in yields makes that conversation all the more interesting. Let's get some more market insight here with Sarah Hunt now, Alpine Saxon Wood's chief market strategist. And besides the data, you're also seeing the bond market reacting, and you have all that uncertainty, as we've been talking about. How does this change your thinking?
Don't we always have uncertainty? Like,
it's
I
crazy
always
right
notice
now.
that. It's
Well, how
constant.
crazy is it?
I think we always have uncertainty, but there are times when you feel like there's a trend and you can sort of follow it. And you can say, okay, things are drifting higher, things are drifting lower, they're getting much better, they're getting much worse. And what we seem to be now is in a very choppy phase for data. And I think that that's why it seems there's extra emphasis on every single data point that comes out, because we don't really have a direction that you can point to and say, the totality or like the majority of things are going X way. It doesn't just really seem that way at the moment.
It feels like you can see that in the S&P 500, at least over the past week or so. We've been hanging out near these all-time highs, but can't really pick a direction to go in right now. When you think about all the uncertainties that are out there, all the cross currents, how are you separating signal from noise right now?
I think that really what it's going to come down to for equities, more so than the bond market, is what the trajectory of earnings is going to be and what it's going to look like into next year. We already are building in some real growth there. You've seen a couple of companies come out with some warnings and some numbers that are not so great on the auto side, on FedEx and things like that. You've also seen some stuff on the tech side do very well. I think for equities, it's going to be about the earnings picture, because if the economics picture slows down, you have to have that earnings growth. On the bond side, it's really going to depend a lot on what the Fed is doing and some of that other data that we're getting. We're getting payrolls data tomorrow. There's a lot of stuff that's coming that the bond market will react to, but there's something where you can actually say, since early summer, yields have been coming down. Now, whether or not that's the right direction, it doesn't matter. It's been fairly directional, and it hasn't been as bouncy as some of the bond moves had been earlier.
So at the end of the day, do you think that earnings picture is going to be as strong as it seems? Especially, I hate to keep bringing up the uncertainties, but if you have these port strikes, if you have potential supply chain issues here, and anything that could really even make the corporate picture more muddy, how does that make things difficult headed into the end of the year?
Those are all bad things, too. Those
right.
those are certainly bad, right? The port strike, not good. The supply chain issues that come with that and the hurricane, not good. The tensions in the Middle East, bad. The election, even if you get the outcome you want in November, in October, not good, right?
No, because it's still uncertainty in October. Once you get an outcome, that takes some of that uncertainty away. And rightly, however the market interprets that, that's going to be one piece of information off the table that they no longer have to worry about. I think the issue with some of these short-term problems, and let's hope that the port strike is short-term, because if it's long-term, then those ancillary effects will knock on for longer, is that it gives companies a little bit of room to say, well, it was because of the port strike, otherwise it would have been okay. Sometimes you get those certain events that allow companies to not achieve earnings, but it's not something that's systemic, so it may not be forever. There might be a little wiggle room there, we'll see, but you really need to see some sort of growth there, because with all-time highs, you're sitting at valuations that are pretty rich.
And let's talk a little bit more about the relationship between the bond market and the stock market that you mentioned, because it feels like it's very hot and cold, that the stock market will be listening very closely to the bond market, then it doesn't seem to matter. Right now, it seems like you're saying that there is a gulf growing between the two in terms of who's the tail and who's the dog and whether or not they're even talking.
Well, our rate's coming down because things are good, and the Fed's going to, the Fed is able to normalize the curve, and it's going to be okay. Our rate's coming down because there's a flight to safety. There's a lot of different reasons for movements in the bond market, and I think equities are pricing out a pretty happy future. The bond market is somewhat more cautious. Whether or not one is right or the other is wrong right now is difficult to tell. And I think really the question is going to be, can we slow things down enough that the equities can be fine while the bond market gets to have lower rates? And I don't think the answer is really solidified yet. Money
has to go somewhere now, right? As rates continue to come down, more and more people are going to be taking cash and deploying it elsewhere. Do you think that's true, A? And then B, do you have any indication of where it's going to go?
Well, I think that's true. I mean, it's interesting to me that we talk about the fact that cash has got to get off the sidelines because rates have come down, when the argument was that there's so much cash you can go buy bonds with it. So that argument has always been a little bit odd to me, because for some people, they're going to keep cash no matter what is going on elsewhere. I think to the extent
even if they're only getting 3%?
Well, they were getting zero, right? So it's a relative game. And
right.
To the extent that some people feel more comfortable with that, when you see volatility, they'd rather have certainty than not. You also look at equities at these valuations and you go, okay, maybe I would put some of that money into equities, but I probably wouldn't put all of it immediately. And then you start to look at that broadening out of the 493, right? You start looking at valuations that don't have double digits that are higher than a normal PE ratio. And I think that that's where there's been a lot of back and forth right now about where money's going.
I think I would be a lazy trader. Keep it in 3%, call it a day, not look at it.
But in three, I mean, for a lot of people, I know the 5 handle is what sucks them in. Yeah.
So the other thing people are buying lately, I think this is a really important question. We've been talking about sectors a lot as part of this rotation trade. The last couple of days have been complicated because you've seen energy prices soaring. You're looking at Brent above 75, still 3 days of gains there.
That's still low.
Yeah, but
right?
There are worries that it might spike higher. There's a lot of geopolitical conflict out there, and the energy sector in recent days has really been leading the S&P higher. To the extent you've seen gains, they've all come from energy. So how sustainable is that at the end of the day? How do you feel about that sector in particular?
In particular, so I think that there's a couple of crosswinds going on, one of which is that we do have a supply issue in the oil market because we're not undersupplied in the way that we might have been in prior periods. The other thing is, however, that if you look at the last year or so, it seems like there's a zeitgeist change and people are realizing that hydrocarbons are not going away as fast as they thought they were. You look at all the auto companies who are talking about making a shift away from pure EVs because they're realizing that hybrids are much more what the consumer wants. Whether or not that's what governments want or regulators want, people don't want to be stuck in a pure one way or the other. So all of a sudden that hydrocarbon tail starts to look a lot longer. So I think it's investable. You've got good dividend yields there. You do want to be careful because valuations, come down when oil comes down. So you've got to look at where the commodities are going. But from a longer term play, I think there's some really nice dividend yields in that area. And I think you've got legs.
First of all, I was talking with Hannah Elliott yesterday on my podcast. I have a cars podcast called Hot Pursuit.
If y'all didn't know.
He mentioned it an hour ago.
Well, no, she just recently interviewed the new CEO of Bentley. The old CEO of Bentley had said they were going to have all-electric lineup by 2030. The new CEO of Bentley says they'll still have gas cars in 2050. So that's one thing. The other thing is you and I were talking about on the desk this morning, the oil price. It really hasn't shown any risk premiums commensurate with the potential of an Israeli attack on Iranian oil supply, right? I mean, look at where Brent crude is trading. 75 is nothing compared to it's been in the high 80s this year.
You could ask the same for a lot of assets, can't you?
Well, I think with oil in particular, one of the reasons that oil is not as reactive to the Middle East issue is because the production in the U.S. is so high. It used to be that there was only production in the Middle East that was flex production. And so far that has changed with how much production you're getting on non-OPEC. If you got some real problem that really limited production out of there for some period of time as opposed to a temporary problem, then I think you would see much higher oil prices. But right now, the bets clearly are on the fact that whatever happens there, it's not going to be very long lasting and it can be made up in other places.
Right, and that's been the story of oil for at least the last year and years, that this is a supply-driven market more so than that poor risk premium that a lot of people have said should be built in. Sarah Hunt, we have to leave it there. It's great to see you. That is Sarah Hunt. She is Alpine Saxon Wood's Chief Market Strategist. Meanwhile, let's take a look at the stocks that are moving this hour. We're going to do that with Jess Menton.
Well, I'm taking a look at EVgo, and if you look at this stock, up about 40% here this morning, on pace for its best day if it holds onto these gains to the close in about 3 years. And what happened here, the Department of Energy actually offered the company another $1 billion loan here for its EV chargers. And you have JP Morgan actually upgrading the stock with a buy rating to about $7. Right now it's trading above $5 a share, but it did downgrade its outlook on ChargePoint. If you look at EVgo, though, its stock's up more than 40% year to date, so something to keep an eye on. And of course, have to bring up Tesla because, of course, earlier this week, we did get the numbers for its deliveries for the third quarter that did disappoint investors here. But what happened this time around, what's keeping basically losses in check today, is looking at what happened with apparently with its Cybertrucks here. Actually, it had its 5th recall in the last year. There were some issues when it came to backing up some of those trucks. It deployed a software to try to help that situation, but they said it only is affecting a small number of vehicles. But nonetheless, you have this stock down about 5% already in just a few sessions this quarter already. And of course, it had rebounded over 30% in the third quarter after being one of the worst point decliners in the S&P 500 in the first 6 months of the year. And I know that y'all are actually going to be interviewing the Levi CEO at around 10:30 a.m. Eastern time today. If you look at this stock, on pace for its worst day since June. Of course, this did come after it lowered its sales outlook for the year. It previously was looking for a range of around 1% to 3%. Right now, it's only looking for about 1%. Some of that came because of its Dockers unit. And it actually is looking for strategic options to potentially look at what it can do to restructure that particular segment of the company. But there was a lot of excitement because, as you all know, Beyonce actually earlier this year released a song related to Levi's, and she's actually part of this advertising campaign. So Citi was talking about there was a lot of excitement going into this report. Maybe those expectations were a little too high, but nonetheless, people want to see if maybe Beyonce can come in and try to kind of rejuvenate the brand, guys.
I had no idea about this.
Cowboy Carter?
That Beyonce put out a country record. I didn't know, and I feel like this is the kind of thing I count on the two of you to tell me.
Well, the show hadn't started yet, to be fair.
I was disappointed in you for not knowing, but he threw it right back at us.
I have her
disappointed in me
to the
for
left,
not screaming at
to the
you
left.
about it.
Yeah,
Everything
that was
you
like
own in the box to the left.
15 years ago, but that is a Beyonce song, so you're right there.
All right, coming up, our next guest says the port strike could not come at a worse time. We'll speak to the CEO of Seanergy Maritime Holdings next. This is Bloomberg. Getting out of high interest to look at what's making headlines around the world. Overnight in the Middle East, Israeli warplanes dropped bombs on Beirut after 8 IDF soldiers were killed in fighting around southern Lebanon. Israel claims to have killed 15 Hezbollah fighters in the strikes. While the conflict rages on, the U.S. has been urging Israel not to attack Iran's nuclear facilities in retaliation for Tehran's missile barrage in the last couple of days. President Biden will take an aerial tour of areas in Florida hit by Hurricane Helene later this morning before traveling to affected parts of Georgia this afternoon. 1,000 troops have been deployed to assist the National Guard and general aid workers working across 6 states ravaged by the weather. The death toll has risen above 180, and the destruction is expected to cost insurers over $6 billion, but the majority of the damage is not going to be covered by insurance. And more than 3 dozen container ships have anchored outside some of the biggest ports on the Gulf and East Coasts. The bottleneck is only going to grow as a U.S. dock worker strike intensifies and threatens to disrupt supply chains across the country, as well as in Europe and in Asia.
Matt, I want to bring some breaking news as well, because President Joe Biden is saying that they're discussing Israel striking Iranian oil facilities. You are, of course, seeing an immediate reaction in the market as well. You have Brent prices now spiking more than 4% to $76, almost $77. You have the S&P 500 now turning negative, was trying to turn green a little earlier. And you have New York crude also spiking more than 4.3%. And yeah, there you have it. You see over the last couple of days, but now, of course, if they were to strike Iranian oil facilities, that would create another question about supply, Katie.
Well, this is what we were just talking about, Sonali, that this is a supply-driven market when it comes to oil. Over the past 2 years, that has been the case. Now, this is where the two sides start to meet. Those two factors start to intermix. Of course, Biden saying that they're discussing Israel striking Iran facilities. That's why you're seeing this big reaction, though, Matt, to your point, still below levels that we were at just about a month or two ago. Yeah, that's right. Let's talk a little bit more about the container ship situation as well for the impact of the strikes. We're joined by Stamatis, Tsantanis. He is the chairman and CEO of Seanergy Maritime Holdings, a company that operates 19 dry bulk vessels. He's also the founder and CEO of United Maritime Corporation. Stamatis, a very interesting and concerning situation in terms of the port strikes. I want to ask first about container prices, because we have been told by the longshoremen that prices for some containers have already spiked to $30,000. Meanwhile, I believe that the companies are telling us actually, no, it's $9,000 at most. Where do you see container prices right now compared to where they've been?
Hello, good morning, and nice to be here. First of all, it's very important to say that the rise of the container transportation cost is not only because of the strike that is going on right now in the eastern coast of the United States, but also it's the general geopolitical disruptions that have been taking place for quite some time. So I must say that right now the strike is one of the factors affecting the supply chain. The most important has been really affecting the supply chain, not just for containers, but also for dry bulk cargoes, raw materials, and oil, has been the closure of the Red Sea and the avoidance of many ships passing there. So right now what's going on in the United States and the east coast of the United States has been like the icing in the pudding, to put it this way, of the overall disruptions that are taking place.
But what about the price, Stamatis? What kind of prices are you seeing for one 40-foot container from Europe to the east coast of the U.S. right now?
From what I understand, it's somewhere in the mid-teens. That's what we understand to be the cost of what it is. But that varies, and you cannot really get a certain price these days with all these things going on.
It's interesting because we do want to definitely bring you back to the port strikes here in the United States as well. But given the geopolitical conflict we're seeing, what type of risk is there for further escalation in kind of areas across the globe here? You mentioned the Red Sea. What kind of disruption could there be over the next couple of months? I think a lot of the market is discounting that.
Of course. I mean, generally shipping and all the overall transportation of raw materials and goods around the world has been taken kind of for granted. People expect things to be in the gasoline station, bridges to be built with the steel produced, and the consumer goods to be delivered in the supermarkets or whatever else. When you have all this geopolitical turmoil going on around the world, it's kind of difficult, to make the service that we produce for the consumers, and everything gets more and more expensive. And I think that I don't really see any end in the tunnel right now, because you have so many things going on right now. If there's like a conflict in the Middle East, you may have the Persian Gulf closing down. You have the Suez Canal not closed exactly, but people are avoiding to pass through the Suez Canal, and they're diverting the ships around the Cape of Good Hope. So there's so many things going on. Things are going to get more expensive for the consumers. Disruptions will likely take place. So I'm not optimistic at all with what's going on right now.
I want to come back to the ports here in the United States as well and get your opinion here about how this might play out. Of course, this has the potential to cause potentially hundreds of billions of dollars worth of disruptions. How much, in your view, leverage do the unions have in this strike?
Well, it's an election period, so I cannot think, and it's a highly contested election period, so I cannot think of a better leverage right now to apply on the US government to resolve it. So, I cannot think of a better timing than that. And on top, as I mentioned before, you have the geopolitics. So it's not just, some ports in the East Coast closing down and all this container traffic, the millions of TEUs not being able to be discharged, but most importantly is the overall global situation. So there's a lot of pressure on any government right now to resolve it as quickly as possible, because the overall increased incremental cost of the consumer is going to be much, much higher.
Stamatis, I want to ask just quickly about automation. Only got about 30 seconds left, but do you believe we could make great breakthroughs with robots unloading terminals, or is that still 10, 20 years off?
No, it's not, because if you look at most of the terminals around the world, they're all almost fully automated. And, the United States ports altogether and the infrastructure, in my opinion, has been left behind. And, if you travel to big ports around the world and you see the level of automation that has been going on and the robotics and all that, it's mind-blowing. So, in my opinion, it's a one-way street. I don't see anyone escaping the automation, which is going to happen.
Yep. Stamatis, great having you on the program. Thanks very much. Look forward to having you here in the studio with us when you visit New York. Stamatis Tsantanis, Seanergy Maritime. This is Bloomberg.
All right, let's get back to that breaking news. Of course, President Joe Biden, when asked if he would support Israel striking Iran's oil facilities, responds, we're discussing that. That is all the detail we have right now. But what we do have is the market reaction. You take a look at oil, for example, crude oil currently up about 4%. We are trading just below $73 a barrel. Of course, the intersection of that war risk premium and supply dynamics. You're seeing it right now in the oil market. You're also seeing it when it comes to the equity market. Of course, the S&P 500 now down close to session lows, down about 0.3%. Of course, it did rise after we got that stronger than expected ISM services numbers. We briefly went green on the S&P 500, on the NASDAQ 100, but those gains have been erased, currently down on both of those indexes. Meanwhile, the 10-year Treasury yield still higher, not seeing a haven bid there. The 10-year Treasury currently up about 4 basis points.
And Katie, coming up, we're going to talk to the CEO of Levi Strauss. Of course, the shares are slumping after the iconic brand trims its outlook. That's up next. This is Bloomberg.
And we welcome now our Bloomberg TV and radio audiences. And we're focusing on shares of Levi Strauss, lower today in a big way after the denim maker narrowed its full-year revenue outlook. The company also revealing that it's exploring a sale of its Dockers brand. Joining us now, I am thrilled to say we have Michelle Goss. She is Levi Strauss president and CEO. And I think a lot of people were surprised by these results because fashion is fickle, but denim is back in a big way right now, of course, over leggings. You have this collaboration with Beyonce. The song came out as well, and yet, of course, you narrowed that revenue forecast. So how can you reassure investors that, of course, Levi Strauss is on that positive growth trajectory?
Yes, well, it's great to be here, and thanks for the question. You know, what I would say is, first off, we're really confident in our long-term strategies for the business, and ultimately we see the business growing to about $10 billion in sales over time, and our strategies are working. I'm sure we'll talk about that. But let me set a little context for the quarter. Despite coming in at the low end of our guide, underneath that, there's a lot of strength in the business. I mean, clearly we beat our profit targets, our earnings were strong. And as it relates to revenue, overall, we were up 3% on an adjusted basis. The Levi's brand was up 5%. Yet we did have a couple areas that underperformed, namely our China business, Mexico, and also on Dockers. In terms of China, I would say that we have our own executional opportunities there. It's a big market. We see the long-term potential. We've changed out some leadership, and clearly issues have been exacerbated by the macro headwinds. In Mexico, we can isolate that issue to our wholesale business there, where one of our top customers had a cybersecurity breach, which impacted our ability to ship. We expect sequential improvement there as well. And then lastly, with Dockers, I mean, that's a brand that for us, it's underperformed for some time. We do believe that both Levi's and Dockers will ultimately benefit by being independent businesses. And for us, this is about focus and us focus and amplifying on the Levi's brand and also on Beyond Yoga, which we just acquired a couple years ago.
Well, I'm glad that you brought up Dockers because that's exactly where I want to go. Of course, you said that you're reviewing options for Dockers that could include a sale. You have the likes of Bloomberg Intelligence coming out and saying that if you did sell Dockers, it could free up resources to accelerate your direct-to-consumer expansion. But what options do you have if a sale doesn't happen? What else are you looking at for Dockers?
Yeah, I mean, as we shared yesterday, we are exploring strategic options, and our intention is to sell the brand to the right potential buyer. I'm actually quite confident in that, but we're all doing our homework around that. But to your question, this is all about distorting our resources against largely the Levi's brand. We see so much opportunity for that brand and for that business, and also accelerating Beyond Yoga, as I just mentioned. But as it relates to the Levi's brand, today, Levi's, we've been in business for 170 years, and we're really known and famous for the blue jean, of course, the 501. But we see an opportunity that's much greater in really evolving the brand to stand for head-to-toe denim lifestyle. And, that's a big part of how we're seeing the momentum in our business. We talk about the Levi's brand being up 5%. Well, that was driven by the strength of our direct-to-consumer business, both in our stores and e-commerce. DTC was up 12%. E-commerce up almost 20%. And we're seeing that across the world. And, I'd say two things underneath that. Real strength and opportunity in women's. Women's is about a third of our business today. That should be half, and we're well on the path. And then head to toe, whether that's denim dressing, denim lifestyle, and even tops to complement our bottoms. So there's just so much opportunity. So as we really focus on Levi's, like I said, we see accelerating into the future.
Michelle, I'm sure a lot of investors would love to see that continued investment, but one more on the Dockers sale here, because the faster you would be able to sell it, the faster you would have that money to reinvest. How soon do you think you can exit the Dockers brand?
Yeah, I'd say we just announced it yesterday. We have a great team working on it, so we're not putting a timeline, but we'll keep you posted.
I wonder about the styles. If you look across the more expensive Japanese denim, you can see $300, $400 prices for Samurai and Ironheart. You're almost there with like 1933 501s. Do you feel like you have any? Those are like $295, right? Do you feel like you have any pricing power pushing higher?
Absolutely. I mean, one of the amazing things about this brand is just how broad we connect with consumers across all demographics around the world. And we want to be there for our consumers. So whether that's more of kind of your entry-level price point, all the way up to very aspirational types of denim. And we do selvage, Japanese denim, and we're doing that around the world, including here in the US. And I think as you were just pointing to, vintage Levi's, I mean, the real testament to the strength of this brand is if you're buying vintage Levi's, the kinds of prices that people will pay for that is pretty darn amazing. So, like I said, that's all part of, the long-term potential and opportunity for this business.
Well, it's very cool, Katie.
Yeah.
You can get the actual jeans, at least the cut that they made in 1890. If you're more of a 30s person, they have 33, I think, or 37.
There you
You
go.
can get 40s,
Yes.
50s, 60s. So I think it's a fantastic program, and obviously one of the most iconic names in denim.
I'm so glad you brought that up because, given our authority and authenticity, I mean, we actually do have a vault where we have literally the original pair of Levi's jeans and lots of other iterations. Our teams are constantly kind of scouring the world looking for inspiration. And so our designers do take inspiration from some of our vintage jeans, and we replicate those, and they're super popular with our consumers.
Yeah, absolutely. You really span the time spectrum there, and brand loyalty is there for Levi's. I do want to talk about Beyond Yoga, though, and I don't know if you have denim yoga clothes. Maybe that's in the pipeline there. But let's talk a little bit about the write-down of Beyond Yoga. I know that you recently acquired this one, and I'm not really asking about the magnitude, but the fact that you wrote it down at all. I mean, what does that say basically about whether or not it's meeting its targets, what the future is there?
Yeah, no, great question. So we are very committed to Beyond Yoga, and we are in the very early chapters of the potential of that brand. We did take a write-down this quarter, really reflecting the path we're on to make sure that we have a thoughtful, prudent path on both growth and profitability in our investments. But really, this is about, again, the long-term opportunity for Beyond Yoga. It had a great quarter. We are up almost 20%, and we've seen that double-digit growth for some time. I think importantly, we are investing in this business and brand. We brought in new leadership, Nancy Green, who is an apparel and retail veteran. She's brought in new capabilities and team members. And over time, this brand should be at least $500 million. When we think about Levi's really owning denim and denim lifestyle, having Beyond Yoga really extend the closet into active and athleisure, we feel like this is just a phenomenal platform for LS&Co. to operate in.
Michelle, I want to go to something very fun, right? You had teamed up with Beyonce here in an exclusive ad campaign. Beyonce is queen after all. She couldn't have come cheap. I'm wondering, at the end of the day, what does this give you? Has she helped you reach new communities? What's the payoff?
Yeah. Well, first, let me say, we are so honored to have this partnership with Beyonce. This comes after literally decades of having a relationship with her, dating back even to the 90s. And we've been a fan of Beyonce for a long time, and I believe she's been a fan of Levi's as well. And clearly earlier this year, we were so honored that she named a song after us on her new album, Levi's Jeans, and that sort of then led into a conversation of what was possible. And here we are, just Monday, launching this, what I would call breakthrough campaign. I mean, while we have worked with celebrities in the past and influencers and designers and the like, I mean, this partnership takes us to a whole new level. I mean, she is a global icon, right, across art and music and fashion. And it just made so much sense for us. I mean, Levi's, the brand, is at its best when we're at the center of culture. And there's nobody better than Beyonce to be our partner in that. And accelerating women's. I mean, over the next couple years, our plan is to really take that to the next level. So we expect, through Beyonce, all that she means, and candidly, the reach she has. I mean, she's got hundreds of millions of followers. Like I said, that this is going to be a great partnership for the business.
Can I ask you, just for the overall picture on labor, what your employee headcount looks like and which direction it's going? I mean, are you looking to add employees for more production? Do you need to shut down in order to right size? What are your plans in terms of your workers?
Yeah, so around the world, Ellis & Co., we have about 20,000 employees. Great. I mean, we have a phenomenal culture. I am inspired every day, whether I'm working with the team here or out in the field working with our teams in our stores and our distribution centers. And as I said earlier, our intent is to grow this business. We're $6 billion today, a little more than that, taking that to $10 billion. And over time, we will be hiring more great Levi's employees to bring phenomenal experiences to our fans all over the world. I mean, a big part of our growth strategy is around direct-to-consumer and building more stores across many markets. So for us, it's about growth and it's about profitable growth. And like I said, we look forward to welcoming many new employees into Levi's over time.
Michelle, thanks so much. Michelle Goss there of Levi Strauss talking to us about their quarter and their outlook as well. Is cowboy casual a thing? Is that not? I mean, I've always worn
Western is trending,
jeans.
yes.
That's what I have been saying. Thank you for that, Michelle.
I didn't know it was a new.
Desk.
That's because I thought it was just the way people dress. All right, awesome to talk to Michelle and get a check on the trends with the kids. Let's get a check on the markets right now with Bloomberg's Jess Menton. Jess, what do you see?
Well, looking at the S&P 500, coming off those session lows, of course, we had that service activity data that expanded at its fastest pace since the beginning of last year. So that's helping actually pair the earlier losses that we did see in the S&P 500. Initially, if you look at what was happening in the Treasury market, those yields had bounced higher after we did, of course, unfortunately see some of those jobless claims numbers tick higher. But nonetheless, that service sector data kind of easing some concerns about where the economy is and obviously the consumer. Have to point out, though, what's happening with crude prices, getting that spike there after President Joe Biden said they are discussing potential plans here for Israel to attack Iran's oil facility. So you are seeing crude oil spiking higher here. Also, energy stocks like Exxon, Chevron moving higher on the back of that. Of course, we were supposed to get an update when it comes to natural gas prices today at around 10:30 a.m. People were keeping a close eye on that to see whether or not stockpiles would become under those estimates there, but actually did come in below those median estimates. And this is important because a couple of years ago, when you looked at a rise in natural gas prices, that did hurt President Joe Biden in the polls. We only have about 5 weeks left before the presidential election, so that's something that traders are keeping a close eye on. And then, of course, looking underneath the hood, NVIDIA moving higher here on that deal that it has investing in OpenAI. That'll give it some more insight into how those chips are working and what OpenAI is working on. And then, of course, Southwest actually now moving higher, had initially been a little bit lower. But actually, if you look at this, insiders are stepping in, actually more than $100 million to try to support the stock there. And as Stellantis, unfortunately, got a downgrade by Barclays, they actually cut their outlook on the stock by over 40%. So that's why you see that stock down close to about 4% right now. And as y'all just wrapped up that interview with the Levi CEO, if you look at that stock, still on pace for its worst day since June, down about 8%. But if you look at other companies in that similar space, like Contour Brands, I know Matt was just talking about different sort of cowboy-related outfits here. But if you think about Wranglers, though, that's one of the, actually, if you think about what it owns within the company, that stock's also getting pressured, as well as other apparel stocks as American Eagle and the S&P 500, guys.
All right, Jess Menton, great roundup as always. Thank you. Meanwhile, coming up, a story about computing power. KKR's global head of digital infrastructure discusses the cost of building data centers. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And have you ever wondered how much it costs to house gigawatts of computing data? If so, good news, because David Weston spoke with KKR's global head of digital infrastructure about the high price of building a data center.
Oh, it's the scale is truly just mind-boggling. So today, if you think about a data center, it's a gigawatt data center, and you can sort of scale it up or down. But typically today, we're talking about hundreds of megawatts to gigawatts for a data center. So a gigawatt data center would cost about $12 billion to build, just the infrastructure for the data center. About 10% of that is to build out the land. 50% is the equipment, and then 40% about the labor required to sort of build out the data center. And then if you on top of it add the equipment that our customers put into the data center, which is typically 2x what you see our investments. So a gigawatt data center would cost you $40 billion. So put that in perspective. Hoover Dam in today's dollar was $1 billion. In today's dollars, it was $1 billion expense. So we're creating a lot of that, daily, so to speak. Just another interesting data point. Over the last 12 months in the United States, we've added 5 gigawatts of data center capacity. So that's 5 gigawatts. That's equivalent of 2 LAs coming in on the grid, so to speak. So it's really, the scale is really profound.
Give us a sense of the business model, as it were. I mean, you put the capital in, you fund the building of a data center. How does the revenue come back? I mean, do you have to wait for down the road, or is there immediate revenue in customers who are paying?
Yeah, so most of the data center capacity that's built out, it's anchored by a customer contract. So it's a take or pay contract. So typically we would build the facility, which we take some level of development risk on that facility, but it's largely contained since this is an industrial facility in many ways. And then we lease that facility to typically hyperscale customers under a long-term take-or-pay contract, anywhere from 10 to 15 years. It has an inflation adjustments associated with that, but you think of it a development cycle over a couple of years, and then you effectively collect rent, just like any other pseudo real estate asset class.
Talk about the hyperscalers, as we call them. What is their decision process about whether they just build their own or let somebody like a KKR build one and do a 10 to 15 year contract for it? They
do both. That's the short answer. But I think they're also trying to think about keeping up with their level of growth. So a cloud is a business. 10 years ago, it was a $50 billion business. Today, it's a $500 billion business. Over the next 7 years, expected to quintuple in size. So they're trying to keep up with the level of demand. Furthermore, their core capability is to ultimately develop and sell software. They have a better use for their capital deployment than to lock it up in hard infrastructure. So they're using third parties like us to effectively augment their deployments and to get the operating leverage and the efficiencies from effectively deploying this infrastructure.
Is this structure for KKR somewhat different from what we think of as traditional private equity, where you basically buy a company, somewhere down the road you sell it, and then you can distribute back to investors? Is this different where you're actually getting a stream of revenue that can be distributed to investors early?
That's right. So in our infrastructure vehicles, we have sort of two components to it. There's an ongoing yield strategy, so we develop and effectively return capital through a yield, and there's also a value creation through capital appreciation. So it's a mixture of both. And I think that's why data centers or infrastructure broadly defined is a really interesting asset class, because you get an ongoing yield and you have the capital appreciation on the back end of investing in this mission-critical infrastructure.
And that was the global head of digital infrastructure for KKR speaking to our own David Weston. And David joins us now. And David, obviously we talk about AI, we talk about data centers all the time. We don't often talk about what actually goes into building these data centers, and turns out it's a lot of money.
It's an awful lot of money. It's stunning how much money, isn't it? And I'm fascinated by the business model as we went into it there, because it's a huge amount of money. At the same time, you lay off a lot of the risk because you have long-term contracts even before you build the data center, so you know you've got revenue coming in addition to the appreciation down the road. So it's a fascinating business, even though the numbers are, as you say, astronomical.
Does it make any difference that the Fed is cutting rates right now? Or are they trying to lock in contracts when we're at 5% rather than than waiting until we're...
The money is so much and the time horizon is so long, I don't think so. I mean, what gave rise to this was we kept talking to people in commercial real estate, which has really been struggling, saying the one place that's great is data centers. So we said, well, let's go take a look at why that is so great, how much they're, and they can't make them fast enough. It's quite stunning.
David, one thing I find interesting is there's cost and then there's resources. What did he say about the energy needed to really come into these things and the cost of that?
And the energy is enormous, as you know. It's just, I think, isn't the going expression is that to do a Google search, it's 10 times as much energy if you do it on ChatGPT. So it's a huge amount of energy, and it's growing enormously. The estimates right now, it's going to be like 4% of total energy in the world is going to be devoted to AI. So they have to deal at the same time, as you know so well, Shania, KKR is saying we want to go green. We want to do good things for the climate. So we talked about how they're doing that. And they're co-locating, for example, renewable energy sources at the same time. And we also have been talking now with some nuclear sources, because that's really interesting, particularly with the small modular nuclear reactors. They think they can co-locate that with some of these data centers, so you're not sending a bunch of carbon into the atmosphere.
Well, great conversation, of course, on the business of building data centers. Our thanks, of course, to David West. And you can catch the full conversation on Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. All right, let's get a check on these markets right now. A lot of intraday volatility. The S&P 500 currently a little bit lower. The NASDAQ 100, your big tech names, flipping green, of course. A lot of sentiment shifting. We did get better than expected ISM services figures at the top of the hour, but then we got this report, Biden speaking to reporters outside of the White House saying when he was asked if he would support Israel striking Iran's oil facilities, he said that, quote, we're discussing that. You can see the impact in oil right now. Of course, oil initially spiked. It was up 5%. Now taking back some of those gains, you can see Brent currently up about 3.5%. New York crude up about 3.9% right now. So we'll see how the day settles up. Of course, big tech has managed to shake it off right now. The NASDAQ 100 is managing to hang out in positive territory.
The comment from Biden was pretty vague. He says that we're discussing that. But I think part of the problem here, and you see VIX elevated as well, back to 20. It's been kind of hanging out there, give or take. It's that you don't know how much the U.S. is going to be continued to be dragged in, I think, is part of the issue here.
I think, they got to hit them where it hurts is probably their thinking. Economically, that would be the oil. Or, Iran has been so vocal about how serious they want the Israelis to avoid their nuclear facilities.
Biden wants that as well
Yes.
when it comes to Israel. So we'll continue to follow that story. But looking ahead, coming up tomorrow on Open Interest, we have an all-star lineup for Jobs Day. Austin Goolsbee, BlackRock's Rick Reeder, Tiffany Wilding of PIMCO. This is Bloomberg.